When gold crashes during a war, most people do not realize they are watching two different markets argue with each other. The paper market is shouting panic. The physical market is quietly taking delivery. That is the real story. And if you do not understand that split, you are going to misread the entire event. You will think gold failed. You will think the safe haven idea was a lie. You will think war no longer matters. You will think the people selling must know something terrible about the long-term case. Usually they do not. Usually they are trapped inside the wrong structure. So let me give you the one mother line that everything in this story serves. Gold does not always crash because confidence died. Very often it crashes because paper leverage panics while physical ownership transfers. That is the line. Not inflation, not fear, not headlines, not some mystical betrayal of gold. Role in a crisis, paper leverage, physical transfer. Once you see that, the whole move becomes easier to read because there are two ways to own gold. You can own it as a real reserve asset, or you can rent exposure to it through products and contracts that are designed for speed, not endurance. Those are not the same thing, and when war, oil shock, higher yields, a stronger dollar, algorithmic selling, and leveraged product mechanics all collide at once. The rented exposure gets liquidated first and hardest. That is the paper panic. Meanwhile, the people who actually want physical metal, sovereign buyers, patient accumulators, Eastern demand, long horizon holders, can treat the same event as a transfer of inventory at a discount. That is the physical transfer. One market is selling because it must, the other is buying because it can. If you confuse those two motives, you will confuse the whole reset. So let me start where most investors get fooled. They think gold is supposed to rise automatically in war. That belief is too shallow. Gold is not merely a safe haven sticker. Gold is an asset priced through a market structure, and market structure matters. If a war causes oil to spike, inflation risk to rise, central banks to look more constrained, bond yields to rise, the dollar to strengthen, and machines to dump paper gold automatically, then the immediate path of the paper price can be down even while the long-run reasons for owning gold are becoming stronger. That sounds contradictory, only if you treat gold as a slogan instead of a market. In reality, it is exactly what happens when short-term pricing pressure and long-term strategic demand point in opposite directions for a while. That is the first mechanism. I call it safe haven override. A lot of investors think the safe haven effect dominates everything else. It does not. In the short run, a stronger dollar and higher real yields can overwhelm the simple war equals gold up story, especially when systematic funds and paper traders are using preset rules to allocate capital. When bond yields rise, cash, like paper, starts competing harder for money. When the dollar rises, gold gets repriced through that lens. When volatility surges, machines do not stop to ask whether bombs should be good for gold in theory. They respond to inputs, yields up, dollar up, momentum, broken, sell. That is safe haven override. It does not mean gold ceased being strategic. It means the paper machinery is temporarily stronger than the simple story people learned on the internet. That is why I never trust a war narrative by itself. I trust structure. And the structure here says the path of paper gold can be viciously lower even as the deeper long-term case remains entirely alive. Now let me take you to the second mechanism. I call it machine selling. This is where the public gets outgunned without even realizing the fight they are in. A large part of modern market movement is not driven by thoughtful humans carefully weighing geopolitical logic. It is driven by systems, rules, fund mandates, leverage triggers, and algorithmic models that react to price, volatility, yields, currency moves, and predefined technical levels. These machines do not care that it is war. They do not care that gold is supposed to be a hedge. They do not care what your favorite macro commentator said last week. They care about the input set, if rates rise, if the dollar rises, if support breaks, if momentum flips, if volatility forces de-risking. Then gold gets sold automatically. And because the size behind these flows is large, the selling itself becomes part of the next trigger. Lower price creates more breakdown creates more selling creates more volume confirms weakness to other rule-based systems. The cascade continues, that is machine selling. It makes a decline feel far more violent than the casual investor expects because he is still imagining a market where opinion alone sets price, opinion matters. But in fast markets, structure often matters more. And if you do not respect that, you will keep looking for comforting narratives while the machines are unloading size into the tape. But machine selling alone is not enough to explain what happened. That brings me to the third mechanism. I call it leveraged fragility. A great many retail investors never truly own gold. They own amplified gold. 2 times products, 3 times products, leveraged ETFs, fast money instruments that promise a multiplied daily move. These products feel brilliant on the way up because they flatter the holder. A small rise in gold becomes a large gain in the account. The investor feels early, sharp, maybe even gifted. But the structure has a hidden cruelty. It must rebalance. Every day that means when the underlying price falls hard, the product is forced to respond mechanically. Retail holders get margin called, or they capitulate, or the ETF itself has to adjust exposure. That selling creates more pressure. The decline deepens, more holders panic, more rebalancing occurs. It becomes a feedback loop. This is why leverage is not a harmless enhancement to a long-term thesis. It is a path-dependent trap. If your thesis is that gold protects wealth through long cycles, then expressing that thesis through products designed to magnify daily movement is often an almost perfect way to get the thesis right and still lose money. That is leveraged fragility. The public thinks it owns more upside. Often it merely owns more vulnerability, and when a major decline arrives, those products turn healthy corrections into portfolio trauma. The long-term case may be intact. The leveraged holder still gets wiped out because he chose the wrong structure through which to express the right idea. That mistake is common. It is also expensive. Now, let me give you the fourth mechanism, I call it, the 1983 echo. Markets do not repeat cleanly, but they often rhyme through structure. One of the most useful ways to think about this reset is to remember that we have seen Middle East-related gold selling before. In that earlier episode, oil producers faced revenue stress and needed liquidity. Gold was sold to defend systems, fund obligations, and preserve stability. The trigger now is different in detail, but not in spirit. Then, weaker oil revenue dynamics forced action. Now, disrupted oil movement, war pressure, and dollar need are creating the same kind of pressure through a different route. In both cases, the lesson is the same. A region associated with oil dollars and large reserve assets can become a forced seller of gold, not because it stopped believing in gold, but because it needed cash flow and credibility more urgently than it needed to sit still with the reserve asset in the short run. That is the 1983 echo, not because history has repeated word for word, because the mechanism is familiar. And mechanisms are what matter. Now let us step into the fifth mechanism. I call it sovereign distress supply. This is where the story becomes much bigger than retail ETFs and hedge fund algorithms. Sovereign sellers behave differently from ordinary investors. They do not need to announce their every intention. They do not report on a schedule designed for your convenience. Some sell directly, some swap, some pledge, some move inventory through London, some operate through structures that leave behind clues rather than clear press releases, but the logic is visible. When a government or reserve-linked entity needs dollars, gold is one of the few assets that can become dollars fast enough without waiting for a philosophical discussion. That is why sovereign distress matters. A sovereign under stress does not ask, what is my highest conviction long-term asset? It asks, what can I mobilize immediately? That distinction is why gold can be sold by the very institutions that most strongly understand its long-term role. And this is why I do not panic when I hear that sovereign or quasi-sovereign sellers may be in the market. I ask different questions. Are they selling because their strategic view changed, or because their bathtub of dollars is draining? Are they rejecting gold or pawning gold for survival? Is this permanent supply or temporary distress supply? Most investors do not ask these questions. They see the price down and assume the thesis is broken. The thesis may be proving itself. An asset bought for crisis insurance is being sold because the crisis has turned the demand for dollars immediate. That does not make the strategic case false. It makes the short-term path ugly. That is not the same thing. Now we reach the sixth mechanism, which is the one the serious investor must understand if he wants to survive this without letting his emotions betray him. I call it paper to physical transfer. When the paper market collapses but physical demand remains firm or strengthens, what you are watching is not one market agreeing with itself. You are watching a transfer. Paper holders, especially leveraged ones, are giving up exposure because they cannot handle the path. Physical buyers are stepping in because they care about the asset, not just the short-term chart. That is why physical premiums, vault outflows, Eastern accumulation, sovereign reserve logic, and delivery trends matter so much. Paper can scream, physical can absorb. Paper can be manipulated, cascaded, liquidated, and synthetically amplified. Physical is slower, harder, and more final. When the two diverge, I listen very carefully to the side willing to take metal out of the system rather than the side merely trading claims on it. That does not mean paper price cannot fall much further. It can. It does mean that a falling paper quote does not automatically equal weakening real demand. And that difference is where fortunes and mistakes both come from. Now, I want to force the identity shift, because without it, you remain vulnerable to every violent gold reset. Stop thinking like a gold cheerleader, start thinking like a structure reader. A gold cheerleader wants the price to confirm the thesis every day. A structure reader asks what kind of ownership is being destroyed and what kind is taking its place. A cheerleader gets emotionally broken when gold falls during war. A structure reader asks whether the drop came from higher yields, stronger dollar, machine selling, leverage rebalancing, and sovereign distress supply. A cheerleader wants comfort. A structure reader wants clarity. That is the stronger identity, and it leads to a much better operating system. First, separate paper exposure from physical ownership in your mind. They are not the same asset experience. Second, never express a long cycle thesis through a fragile leverage structure unless you are prepared to be mechanically wrong, even when your broad idea proves right later. Third, follow the chain war. Oil shock, inflation pressure, higher for longer expectations. Dollar strength, machine selling, leveraged rebalance. That is the sequence. Fourth, watch the physical side. Premiums, vault flows, delivery trends, Eastern demand, and real accumulation often tell a different story from the paper chart. Fifth, assume sovereign selling is about necessity before you assume it is about conviction. Then test that assumption with the flow evidence. Sixth, prepare for time. A reset like this may not end in a week. It may become a longer, messier, more frustrating transfer than people want. Time horizon matters enormously. Seventh, remember that an asset does not stop being strategic just because the weakest holders are being flushed out of it. This is the heart of the whole story. Gold had a brutal week. That is true. It may have more pain ahead. That is possible. But if what drove this decline was paper panic, leverage fragility, and distress selling, then the right question is not whether gold is dead. The right question is whether you own it in a way that can survive the path. Because a lot of people say they believe in gold, very few are structured to live through gold's worst weeks. That is why the final choice is not simply bullish or bearish. It is structural. You can keep treating gold as a fast trade and get thrown around by every violent move, or you can understand that what happened here was a clash between two ownership classes. The rented exposure was liquidated, the durable demand started taking inventory, the paper side panicked, the physical side quietly watched. That is the mirror. If your position needs constant emotional reassurance, you do not own a hedge, you own a mood. If your structure can survive the reset, then the reset becomes what it has always been for strong hands. A transfer from the overleverage to the patient, from the fast money to the hard money, from people who wanted gold to move now to people who want to own gold through what comes next. That is what this crash is really about, not whether gold failed, whether you understood which market was actually speaking.